of the quarter, the last day of the first half of 2022. What a quick 6 months it's been. Oil prices have averaged Brent crude oil over the 6 months, $105, currently trading at above 116. Little movement this morning in early trade in Asia, but nonetheless, we've got a fairly solid oil price trading well above $110 for many months now. Let's go to India this morning, where we have the great pleasure of welcoming Bill Spindle, who's the Council on Foreign Relations International Affairs Fellow in India. Bill has been on a reporting assignment in India now for many months, on the ground, going to every corner of the country and examining its state of preparation for the great energy transition and the impact of climate change. So really interesting assignment, Bill. But may I start with the harsh realities of crude oil and macroeconomics? How is India, Bill, surviving under the weight of this scale of oil price at the moment? It seems the country continues to grow at a fairly substantial pace.
Yeah, that's right, John. Thanks for having me on. It continues to struggle like everybody, and even more so just because of its tremendous, dependence on imported oil, and to some extent imported coal even. So it's, yes, I mean, even as many of the incentives we've talked about for renewable energy over long term, they're still all in place, but like everybody else, it is scrambling every day to try to lay its hands on enough energy to keep the lights on, not always successfully here. So it's been a real struggle. It's going to continue to be a real struggle. I think they'll continue to do what they can to purchase discounted Russian oil going forward as best they can. They're going to try to keep importing coal to some extent, as well as dig up more coal here. But both those things are quite difficult, particularly on the coal front. I mean, the prices they're having to pay for imported coal are really quite intimidating. So it's a real struggle, and that's really what's preoccupying them. Like much of the world right now, is just getting by on a day-to-day basis and keeping the lights on.
And Bill, just to follow up on that, the big question, sort of, Mark, in the world, I mean, at least from the sort of Western prism, if you like, has been India is not aligning itself overtly with its historical allies, the US and Europe and so forth, in the standoff with Russia. How does that narrative look from within India? Is that an appropriate assessment? Is it likely to change in the second half of the year?
Yeah, I think that gets a lot of media attention. I'm not sure it's quite as big a deal behind the scenes as everyone thinks. I think India, feels that it's going to have to continue to purchase Russian oil for a number of reasons, not least of which it's a lot less expensive at a time. They just feel like they can't afford to pay the higher prices they would need to not buy Russian oil. Does that cause some tensions with their relationship with the US and Europe? On some level, though, as they keep pointing out, it's not as if the Europeans aren't buying a lot of Russian oil and gas as well. And I think ultimately the U.S. understands behind the scenes in a quiet way that India really, I think in the back of their minds, their biggest concern, frankly, is if they were to stop purchasing Russian oil. I think their fear is that ultimately Russia is going to wind up almost entirely dependent on China as its biggest and almost sole customer. That's just not a situation from a security perspective that India can really live with, given that Russia provides so many important armaments, weapons, spare parts that they would need and do need to continue to sort of deal with these Chinese confrontations they keep having on their border. They just can't find themselves. They cannot, it's just not acceptable on a security basis for them to find Russia in a position where China could perhaps use its leverage to slow walk some of those weapons, for example, or even get them cut off. Those are situations India is trying to solve over the long term, but those are really long-term problems. But I don't see a change in sort of their stance on this.
I mean, I think that's in a lot of ways where we're at the moment. The next half of this year with the Ukraine war is the very big geopolitical 10,000-foot view rather than on the ground. But let's go to the US with Ian Nathan, Director of Global LNG Research and Energy Intelligence. Ian, let's just start off with the outlook from the US. First half of the year, the economy and all of its macro headlines, very, very positive, except for this crazy beast inflation. What's the outlook for the second half? Will inflation and its resulting perhaps interest rates / recession finally do some demand destruction or not? What's your outlook for the US demand picture in the second half?
Well, thanks, Sean. What's really interesting is that I think up until a few weeks ago, I think the outlook was fairly solid, and I think now the outlook is still fairly solid, except that the expectation of further Fed tightening and greater economic headwinds and potential for recession are weighing a little more heavily on that outlook. So everyone is watching here very keenly to see how aggressive the Fed will continue to be through the rest of the year. As really is an important indicator. But it's really, I think it's only part of the story. I mean, you still have here in the U.S. You have the summer driving season ahead. Even with high gasoline prices, there's a lot of pent up demand, and it will still be probably quite some effort to really hit demand in that regard.
We have the 4th of July weekend, obviously kicking off the third quarter this weekend. The AAA is forecasting a record, not just an average year, but a record consumption and hence driving this weekend with gasoline averaging across the U.S. at $5 a gallon. How do you sort of put those two things together? There's no sensitivity to this.
Well, I think there are a few things, but part of it is that, you do have a lot of this pent up demand. I mean, we're now getting to really the first free summer in several years. So, you're seeing this, with gasoline prices, but you're also seeing this news with regard to travel at the airports, and there's this real desire to get away. I suspect what you'll see, and is that if you're perhaps spending on gasoline, perhaps that savings might turn up somewhere else. But at least for the summer, the expectation is that that you're going to have fairly strong demand, as you're noting a minute ago.
But I'd have to say that airport sort of nightmare pictures in the news is enough to scare me away from making travel that is, only if it's absolutely necessary. Nothing worse than being stuck in an airport queue 3-4 hours long. Let's go to Umut Shukri, author of the U.S. Energy Diplomacy and the Caspian Sea Basin, Changing Trends Since 2001. Welcome, Umut. The world is turning a lot to the Caspian and to Azerbaijan and even the East Med as a possible source to relieve Europe of its energy crisis. Will Europe be disappointed?
Thanks for having me. Yesterday, the sixth Caspian summit will be held in Turkmenistan. And, after August 2018 and after 5 countries came to conclusion to approve the final version of status legal of Caspian Sea, 4 countries accepted this convention, but Iran yet did not accept this convention, and Iran parliament has to accept the convention. And last December, Sergei Lavrov, Foreign Minister of Russia, asked Iran to be work more on this situation and accept this convention. Regarding your question, as you know,
why is that convention important?
Yeah, after accepting convention by all parliament of these 5 countries, every country will be able to more attract financial capability and invest to huge investment to export and produce more oil and gas from the Caspian Sea. And we have also some share deal between Iran and Azerbaijan, between Azerbaijan and Turkmenistan mainly, and they need to this convention to start a new round of investment in Caspian Sea. Caspian Sea energy resource will be held the potential to play an important role in future EU energy crisis. If EU wants to gradually, and I think you are aware of us also, EU is trying to gradually decrease dependency of Russian oil and gas. And in this regard, Caspian Sea, Persian Gulf, natural resource, the Persian Gulf and Middle East will be one of alternative for Russian oil in EU energy mix. But as I mentioned in our last conversation, Caspian Sea countries need more investment, need political and economic support from the US and EU as well. Without the political and maybe security support, this country will not be able to bring oil and gas from the Caspian Sea and more oil pumping to EU energy mix.
Will Russia allow, facilitate, or try obstruct further development in the Caspian?
From the Caspian resource perspective, Iran and Russia is against more oil and gas from the region to the EU market. Iran is planning to export oil and gas to EU in the long term. The last round of nuclear talks will be held in the Doha without any progress, and it is expected to have new round of the nuclear talks by coming weeks. And if Iran and 4+1 sign a new agreement and revive the JCPOA, Iran will be able to get the market, and it's interested to get back its share and also increase its share in EU energy mix. And due to this situation, Iran and Russia are not interested to bring more oil and gas from the Kazakhstan, Turkmenistan, and Azerbaijan to EU energy mix. But after the approval of convention, I think the condition will be more easy for these countries to more work on bring energy resource from this region to the EU. But it is reality that Moscow and Tehran really oppose any new project.
Bill, just coming back to India and Asia, the big, obviously, sort of surprise in some regards in the first half of this year, as we've just been discussing, has been the resilience of demand, even in the face of very high, $100 plus oil prices, and yet demand has maintained even in India. But now, Bill, going into the second half of the year, the Asian countries also have to contend with a stronger dollar, as well as rising interest rates, which of course they all carry a lot of dollar-denominated debt. I'm wondering, what's your sort of macro impact in the second half of the year as these sort of perfect storm of forces start to weigh even more? We've seen Sri Lanka as kind of the cuckoo in the coal mine. Are there others to follow?
Yeah, looking forward, it's so hard to even think about predicting this stuff, because we really are looking at such an unprecedented array of both kind of economic forces in the region with COVID and this rising interest rate environment, and then the politics around all this energy is really, and the geopolitics around it is really difficult to predict. You've kind of got Europe on the one hand saying we're gonna we're going to put a cap on Russian oil, and it's hard to believe that Putin's not really going to respond to that and preempt it. And so it just seems like we're just going to see a huge amount of volatility. Through it all, it's hard to see energy supplies growing in real significant ways. And while I think, so at some point, we're looking at demand destruction of one sort or another, right? Efficiency gains in Europe, perhaps, or it's hard to see that happening in the US, but mostly just maybe in the form of a recession. And I think all these factors, trying to put them all together and figure out how they're going to wash out over the next 6 months,
I know
year,
India,
and even beyond, is very difficult.
In India, Bill, there's been a move at the state level, I understand, to remove some of the taxation on the ground on energy products. What other kinds of tools do they have? How widespread and how deep is that?
Yeah, I mean, they find themselves in a position very similar to everybody else. There are very few tools that are really going to make a difference. So there's lots of, the central government's ordering states to import more coal, and the states are basically saying, well, who's going to pay for that? Have you seen how much imported coal costs right now? And so they're just not doing it. So there's just a lot of things they're trying, just like in the U.S., where they're trying this gas tax holiday and all that. Most of which have very little chance of changing the overall contours of the situation, which are going to be shaped by these much harder to predict, both economic currents around the world. How will COVID play out in China? How will Russia respond to some sort of a price cap on Europe's part? Those are all going to be much, much bigger factors on all of this. There's little the Indians can do, though. Like politicians everywhere, they're doing their best to show that they're trying.
Ian, the big sort of a change in the world of energy flow out of the Russia's war in Ukraine has been that the U.S. energy market, or as the world's largest producer of oil and gas, that it can be the savior for Europe. In a way, it is the kind of big winner potentially. There's been a lot of promises over the first half of this year of U.S. LNG, for example, moving to Europe as one of the solutions. And we just spoke to the Caspian as being another one of the solutions. But Ian, what is the outlook for energy exports coming out of the U.S. into Europe in the second half of this year, and being a vital difference with the winter ahead? Your thoughts on that?
Well, certainly, it's really interesting that that the U.S. has been, by far and without question, the largest supplier of incremental LNG to Europe, which has been vital this year. And that's it's hard to overstate how important that has been. You're going to see perhaps a little more difficulty in the second half with Freeport offline for some time. And it makes basically what's already a difficult situation potentially worse. But from a volumetric point of view, probably not as bad as Nord Stream volumes being throttled back. In terms of really helping Europe to meet its needs. And what do we mean by needs? We mean filling inventories before the winter, and that. That's something that is of really the utmost importance. So right now you're seeing that U.S. exports, with a very favorable European market, have really managed to come to the rescue. But there are going to be some limitations on how much more can be done in the near future.
On that point, Ian, there's been a lot of criticism from the energy industry, the hydrocarbon industry in the U.S. towards the Biden administration, somewhat open slagging matches in the press. And yet Biden seems to be, although he came into office with a very strong green agenda, he now nearly sounds like a salesperson for ExxonMobil. Everybody in the world produce as much oil and gas as you can. It seems to be the daily mantra from the White House. My question is, where is that relationship now between the Biden administration and the U.S. hydrocarbons industry? Are they finding harmony? Will the U.S. hydrocarbon industry respond in the second half of the year? I mean, we're still 1 million barrels below pre-COVID levels. The world is screaming for oil. It's $116. I know American companies love to make money. Why aren't they putting more money in the ground?
Well, and there are a few things to unpack there. And one is that there has been some mixed messaging coming from I want to say Washington, but from the White House specifically, and and that's not helpful. But on the supply side, this is the sort of thing that I would say is in the works, but it's going to take some time for it to really materialize in a way that is going to make any difference. And and so right now, if you're looking at the oil market, and you need to really note that it's the products market that is really causing a lot of the havoc right now. And that if you're thinking of leaning on a solution of greater crude production as your issue, it's not something that is going to materialize overnight, and something that you shouldn't really count on as something that is going to be helpful in the near term. And I think,
but surprisingly, the U.S. is the laggard here. Nearly every other major oil producer in the world is back to pre-COVID levels. Global demand is back to pre-COVID levels, and yet the U.S. oil production is still under 1 million barrels down. Let's go back to Mahmoud and get his views on, again, Joe Biden's visit to the Middle East, Mahmoud, coming up in the coming weeks. And the sort of general media narrative is coming to look for more oil. I think there's a lot more to it than that. But Mahmoud, your thoughts on how important the Joe Biden visit is? We've seen the leader of Saudi Arabia and Egypt recently, and Turkey. There's a lot of diplomacy going on regionally before his visit. I'm wondering what your expectations are from his visit.
Yeah, it's a great point. Saudi and U.S. has a great relation during the last decade, and especially during the Trump administration, there is a good relation between the leaders of the two countries. But when Biden came to power, I think there is a challenge in U.S. and Saudi relation. But due to current energy crisis, and everyone knows, if every country has a good potential of production capacity, will be able to affect other members. I mean, in OPEC Plus. To maybe decrease or increase oil production capacity, and U.S. aware of this. And during the future, Biden visit to Middle East, especially from the Riyadh, we can see the energy will be the core of negotiation. And from the energy security perspective, high energy prices is against U.S. energy security and national security, and high inflation rate, as my colleague said and mentioned about it.
What if I'm particularly interested in what it means for Turkey? We saw Turkey this week concede to Finland and Sweden joining NATO. So that's a done deal. Turkey's removed its obstruction. Can Turkey get anything out of the Biden administration?
Turkey, also U.S. During the Trump era has a good relation, but when Biden came to power, both countries has many challenges. Maybe U.S. withdrew Turkey from the F-35 jet project, but yesterday Biden administration made a decision to give some F-16 jets to Turkey. And also, Turkey is one of the major U.S. LNG buyer in the region, and trying to increase the volume of LNG from the U.S. And when Turkey increased the volume of LNG from the U.S., decreased the dependency of Iran. It's a very big point for the Ankara from energy security perspective. And in energy transition process, also Turkey will be able to attract U.S. companies' technology and capability to work more on to fight against climate change, and also to deepen the energy transition process in Turkey. From the Riyadh and Washington future of relation, and after the current visit, I think Saudi will be able to help U.S. to handle the current energy crisis, and also U.S. will be able to give more technology in Saudi energy transition process as well. Yeah. Saudi has a long-term plan to work on green gas emission, and U.S. technology and foreign financial capability will be helped to Saudi to work on it to more progress. And also Saudi financial capability is good for more investment in U.S. natural gas and maybe LNG terminal in Texas and other states as well. Okay. This is a win-win game. If both countries will be interested, this is a win-win game for these countries in energy, in fossil fuel and energy transition in next decade.
We must move on to the survey question, which is coming to sort of closing comments, which is the inevitable oil price forecast. Brent crude oil averaged at $105 a barrel in the first half of 2022. Today is the last trading day of 2022, of the first half rather. What will be the average price in the second half of 2022? 6-month forecast. Will it be $10+ higher than the average of the first 6 months? So 10 or more higher than 105, or will it be 10+ lower than 105 on the average in the second half, or the option three, it'll be pretty much same as we've seen in the first half, around $105 a barrel, give or take a few pennies either direction. So do you expect an upswing? We saw even overnight a forecast of $200. I interviewed the Secretary General of the IEF this week. He said he expects to see Brent hit 150 in the second half of the year. And then there are others who are more sort of pessimistic on the outlook for recession and are forecasting in the 90s. So what is your view on the oil price? 10 plus higher than 105, 10 plus lower, or more or less same?
Yeah, I think 10 plus higher, but
just 1 second. We'll get a chance for that result. But Bill, I wanted just to go to you. Well, it's obviously a rare treat to have you on. Give us your views on the first half versus what the outlook might be on the second half, with your work on the ground in India vis-a-vis the challenge of climate. The first half, it seemed we've had a big battle between, or a battle is a bit dramatic, but nonetheless, energy security versus energy transition became a kind of a dominant narrative in the first half of the year because of the energy security crisis. Having come out of COP26 in Glasgow, it seemed very much energy transition had a lot of wind in its sails. I wonder what your thoughts on that debate are and your outlook for it in the second half of the year, Bill.
Yeah, clearly the wind is out of those sails for the foreseeable future, at least through, we've talked about going into this big next COP conference. There was going to be a lot of focus on, getting a real bigger commitments on things like phasing out coal and not investing more in fossil fuels and stuff. Clearly, all that's is just going to be completely off the table at this point. I mean, you've got the European countries talking and the US talking about lots more investment in these areas, which of course means the developing world is hardly going to suddenly go along with, phasing out their coal and stuff. So that is off the table for now. Now, that said, I think, longer term, I still believe the incentives longer term are to push this whole transition along. Are people scrambling now, next year, for the next couple of years? For sure, maybe even the next 10 years, there's going to be a lot of scramble for fossil fuels because security is really the watchword of it all now. That's very clear here in India. It's very clear elsewhere in Europe, but it's still hard for me to believe longer term there's not going to be a larger push to diminish the level of fossil fuel use, or at least stop the growth over the longer period. But in the short to medium term.
I was just going to say, one of the more interesting statistics I heard this week was that gray hydrogen had become more expensive than green hydrogen. That was forecast to take 10 years to get to that point, as it did with solar power generation. Which is
right. Clearly, the immediate incentives, in some ways, the economics look even better for renewables. The problem, of course, is you can't snap your finger and make them appear, even less than you can with oil for sure, and even gas infrastructure. At least people kind of are used to it, know how to build it. So if this hydrogen infrastructure is going to take decades to build out, but the incentives to do so have not gone away, and I can assure you, here in India, they're pushing forward with all that stuff. But nobody sees it as a solution this year, next year, or even in the next 10 years. It's going to be a long-term project.
Ian, your closing thoughts, outlook for the second half. Of course, the big event, the US midterm elections, but also I'd welcome your thoughts on, there's been a few comments, including your own, about the growing LNG exports out of the United States. But the consequence of that, of course, is that it's rising the price of natural gas in the US domestic market, which has always been a relatively low price and competitive, very attractive, but that's rising. I'm just wondering what your outlook for the second half of the year on some of these topics and how big a factor the midterm elections will become.
Well, the midterm elections are I guess at this point it's looking, fairly bleak for Democrats. But I think there's a bigger picture here, which was really the extent to which the Biden administration was going to be able to implement its energy policy, even coming into office, at the beginning of the term. And now, of course, it's faced with not just the high gasoline prices, but also high natural gas prices that, as I mentioned the last time I joined you, was one of the underappreciated inflationary pressures. As several weeks ago, before the Freeport outage, you had Henry Hub at $9 and approaching 10, ahead of the summer cooling season. And so basically, to get to the answer to your question, at least in terms of the U.S. gas market, the Freeport outage provides a little bit of a respite, with Henry Hub sporting a 6 handle for now. But as Freeport starts up later in the year, assuming it does, you're going to see that upward pressure rebound, unless there are some other mitigating factors, like particularly high gas production or other bits and pieces that might impact that. But look, the rise, the Henry Hub's rise up until just several weeks ago had several factors. I had mentioned last time I joined you that there was an underinvestment piece of it, but that, I think, understated some of these other broader issues. Inventories were a little bit down compared to 5-year averages. You have coal prices that are higher than they probably should be, and again, this points to a lot of these broader questions that have been noted earlier, which is not just oil prices that are high, but commodity prices across the complex are making life difficult all around. And even just if you look, just to take the point a step further, if you see further issues with gas in Europe, further throttling back of Russian gas supply, what does that mean in Europe? That means perhaps more use of oil products, diesel and fuel oil, where gas is problematic. So you have these compounding issues that
it looks like
are going to radiate.
The second half might bring some clarity in some areas, but more of the same in others, and ultimately a very resilient demand outlook, which one would have to expect. Let's see the survey question before we close to see where the view of the room is. Will it be as bullish in the second half? We've got 65%. Whoa, a 10 plus higher. Wow. Okay, that is a bullish room. That sort of concurs with a number of the big voices. Goldman Sachs are calling for big numbers in the second half. 10 plus higher is the majority of this room. We'll have to see. There's lots of arguments to say that it will be. Even Chinese demand is really yet to take off this year. If they were to come out from COVID in the second half of the year, that in itself could give you $10 plus. We're going to have to wrap it up there. I'm going to thank everybody. Ian, it's really great to have you again joining us from the US. Bill, of course, from India. And Umud from the Caspian. Really great to have your insights today. And we have Brent crude oil trading on the last day of the half of the year at $116 a barrel, holding in solidly well above 110. No reason why that's going to move. No reason that's obvious, at least. Have a great day, everybody. We'll catch up on Sunday with Week in Review with Mike Muller and Christoph Ruhl. Thank you very much.